Let's get though into the property market with the housing reforms coming under scrutiny as rents continue to climb and vacancy rates remain tight. Anthony Landahl from Equilibria Finance joining me to look at what impact the policy is having. So Treasury said the impact here would be less than $2 a week for renters. I don't think that's right, is it? What are you seeing?
Well, it's not only what I'm seeing, it's what's being reported. So what's actually happening is totally opposite. Treasury and Jim Chalmers said the overall impact of their changes that are impacting investors would be $2 a week. Cotality's recent data for the June quarter indicated rents have already gone up 1.6% to the 3 months to end of July actually. That translates to $11 a week, which is about 5 times more than what Treasury forecast. But if we extrapolate that out a little bit, for example, if there's a 5% increase annualised in rents, that'll extrapolate to about $40 a week in Sydney, Brisbane and Perth. Now that's a lot different to Treasury forecast, and the general feeling is that's the way it's heading. Rents are continuing to rise, and in a limited time we've already seen them go up about 1.6% for the quarter.
So why do you think there's such a discrepancy between the government's forecast and what you're actually seeing on the ground?
Look, I think we have to look at existing landlords or existing investors and new investors. So if we start with existing investors, essentially for an existing investor, the tax changes have removed any negative gearing benefits they might be getting, and they also have changed the capital gains treatment when a property is being sold. So for an existing investor, essentially the post-tax cash flow has changed. So for them, they're looking at making a property profitable. And they're then looking at increasing rent. So there's a lot of rental increases happening at the moment from landlords looking at the viability of their investment property as an investment. Existing investors' properties are always also becoming less liquid. They want to hold on to them because they do maintain some of the benefits. They maintain the negative gearing benefits. If we look at new investors, essentially new investors are out of the market right now. Investor flows have virtually gone dead. So new investors, remind us, is they don't get the negative gearing benefits or any capital gains tax benefits on the way out have changed. The concessions have changed. So new investors are very, very cautious. They can still get the benefits for new properties, but new investors have essentially gone dead in the water. So what we're seeing is existing investors, with some of the changes impacting them, looking at their cash flow increasing rents, and we're seeing new investors out of the market. So in simple supply and demand terms, we're seeing increased demand through migration, we're seeing vacancy rates at about 1.6%, and we're seeing essentially contracting supply of new investors and existing investors holding onto stock, and existing investors also looking at their cash flow, post-tax cash flow, exit strategy and putting up rents.
So does that mean maybe we've been looking at the wrong problem?
Well, the government came in with all these housing reforms that arguably were more about taxation than housing. They talked about helping first home buyers who similarly are very much sitting on their hands because we're having drops in the housing market. Sydney and Melbourne have dropped 4% so far year to date. And if people are talking about a 5-10% drop in the market, some of the higher end markets have already dropped 5 or 10%. So the market is very, very subdued. The fundamental issue is supply in the housing market, and from all levels of governments, whether it's getting a building approvals, whether it's construction costs, whether it's getting construction to actually happen, supply is the main fundamental issue that is constraining the market. It's just not keeping up with demand. A lot of the government focus ends up on stimulus in demand, whether it's first home buyer, incentives and other things to help people into the market, which is driving up the prices over time. Obviously we're seeing a lull at the moment. So the focus should be on supply and making it easier to for developers to provide stock, for people to actually for supply to increase. So that should be the focus. A lot of the focus has been on demand, but the fundamental problem is supply and demand. These government changes that are impacting investors is not going to help supply and demand in an already very, very challenging rental market.
When we talk more broadly about what's happening under the hood, is it then a good time for, say first home buyers because of the fact that there's fewer investors out there?
Yeah, first home buyers are very cautious at the moment. They've still fundamentally got affordability challenges because of the sheer challenge of getting in the market, building a deposit and serviceability. But they're also concerned at the moment about negative equity because we are in a falling market. So if they're going in with a 5% deposit and the market drops by 5%, then they're suddenly in a negative equity position. Obviously, if you take a longer term view, it's likely that the market grows again and they grow out of that. But there is some caution, absolutely, from first home buyers about a falling market and buying in that. Some of the areas first home buyers traditionally buy in are new developments. Traditionally, that's about 30 or 40% taken up by first home buyers. We are seeing some investors now looking in those areas because they do get the negative gearing benefits maintained for new investments. So yes, it's arguable in a falling market that it's a good time to buy, but there are concerns around negative equity, affordability is still a challenge, and we are seeing a very subdued market, even though there probably are some opportunities coming up over the next 3 to 6 months in a falling market.